Hi, I'm Joshua Hunt, a strategic tax and accounting professional and enrolled agent. And today I'm going to answer a question that trips up a lot of business owners and self-employed individuals, which is all income taxable? The short answer is yes, it's all taxable, unless it's specifically excluded by the Internal Revenue Code. But what does that really mean? So in this video, I'm going to break down what the IRS means by gross income, the few types of income that are actually excluded from tax, why misunderstanding this can cause thousands in penalties or missed deductions, and what you can do to protect yourself and keep more of what you earn. So let's start with the foundations. So gross income is defined under the Internal Revenue Code section 61 as all income from whatever source derived. That means all income, cash payments, digital payments, your Zelle, Venmo, Cash App, barter transactions, crypto income, side hustle earnings. The list goes on. It's any income. So if you receive value, it's generally income and it's taxable. But here's where so many people get tripped up. They assume, well, it wasn't reported on a 1099, so I don't have to report it. But that's incorrect. The obligation to report income doesn't depend on whether you get a form. If you got paid, it's taxable, unless the IRS explicitly says otherwise. So here's the twist. There are some types of income that are excluded from tax, but only because the Internal Revenue Code specifically allows it. So let me give you some common examples of income that are excluded. You have gifts and inheritances, life insurance proceeds paid due to death, certain fringe benefits, qualified scholarships, municipal bond interest, certain employer-provided health insurance, and the list goes on. But there's a catch. If it's not listed in the code as excluded, it's taxable by default. There's no gray area in the IRS eyes unless the income isn't income. So for example, you may have cash rewards from a credit card after making so many purchases. This is labeled as a discount and not income, and thus not taxable. So if you're a small business owner, freelancer, or have a side gig, this matters because the IRS is increasing scrutiny on unreported income. And also, digital platforms are reporting more transactions. And for 2025, the 1099K threshold is dropping to $2,500. Misclassifying income or ignoring it can lead to back taxes, penalties, and even interest. So what can you do to stay compliant and strategic? Number one, track everything. Don't rely on 1099s. Track all sources of income, cash, digital, trade, or etc. And then understand your exclusions. Don't assume everything is tax-free unless the IRS says so in black and white. Also use proactive planning because there are legal strategies to reduce your tax burden, but they first start with full transparency of reporting it. And then you want to work with a professional. Someone who understands the code and your business model can help you stay compliant and optimize your taxes. And a bonus, your business income is your profit. I'm going to always keep saying that. Your business income is your profit. So what is taxed is your income minus your expenses that makes your business profit. And so not tracking your expenses will cause you to report higher income and overpay on taxes. So here's the bottom line. All income is taxable unless the Internal Revenue Code specifically excludes it. And it's your job and mine to know the difference. So report it. And then learn how to use the tax code for your benefit. So if this was helpful, don't forget to like this video, drop your questions in the comments, and subscribe for more practical real-world tax strategies for business owners. I'll see you in the next video.